Last week, the majority of the market was down, yet we have Nvidia up nearly 10%, and this is for a stock that is up over 200% just over the last 12 months, yet we have Wall Street indicating this as a strong buy. So today we want to answer whether or not it is too late to continue to add this company that continues to increase week on week, month on month for massive future gains. We've got a lot of deep dives in today's episode. We want to run through some very important slides from their latest investor presentation that you may have missed. We're also going to take a look at the growth of this industry. It is a lot more than maybe you would think in terms of the compounded annual growth year on year. And we're also going to take a look at some articles that maybe you wouldn't have thought relates to Nvidia, but it really does. Massive bullish signals. We're going to look at Tesla's estimated growth from ARK Invest. We're also going to take a look at Broadcom and their earnings, a massive bullish signal for this company. We're also going to take a look at the growth of Nvidia, where it has been historically and where it is estimated to go over the next few years. But we also want to understand what is going on with insiders who continue to sell large amounts quarter on quarter, as well as taking a look at institutions to understand where the big money is going. Are they continuing to add this company to their portfolios, or maybe this is one now that they are starting to look to get rid of, as it has started to increase massively over the last 12 months. And as always, we are going to run Nvidia through our valuation model. We want to get to both our intrinsic value as well as our acceptable buy price, incorporating an investor margin of safety, and we'll look towards Wall Street to see what they're forecasting over the next 12 months. Now in today's episode, we also want to forecast on the updated model, looking at a low, medium and high growth rate forward looking, so you can also understand and maybe estimate your own valuation considering the growth over the next 10 years. Now before we do jump into the numbers, we just want to see historically how has this company performed. Now it is up over 206% just over the last 12 months. If you've been a long-term shareholder, well, you would be laughing all the way to the bank, up 27,000%. That is an incredible return over the last 10 years, yet we do know currently it is sitting in the mid to upper end of the 52-week range. We can also see a forward yield, although very marginal, at 0.03% and a 49 forward PE, but we will discuss this whether or not we believe this is justified given how strong this company has been. And although we do see one massive strong buy from Wall Street, we do note a double hold from both Seeking Alpha as well as Quant. Now one thing that we do want to talk about before we run in again to discuss the numbers is what are the outside parties as well as the inside parties doing. So insider ownership 4.23%, and we in fact note 8 insiders who have sold over the last 12 months for a whopping $469 billion. As we can see in just the more recent quarter, Q2, $238 million. Now in terms of who these insiders are, always good to understand the position they hold. We note the director Mark Stevens just a few days ago, so the 11th of June, did sell a massive 150,000 shares for around $18 million. Now in the same month as well, so on the 7th of June, so just last week, another director also sold 100,000 shares, and as we can see here, $119 million. So whether or not you believe this is a bearish signal and it is one you should consider in buying or selling, the information is there to be transparent. All that we would say is just bear in mind we don't know why they do buy or sell. It could be personal or financial reasons. Now in terms of what the institutions have been doing, 65% institutional ownership, 8.6 billion worth of sales by the institutions, but a lot more buying, just under 67 billion over the last 12 months. However, what is very interesting to note, what we note in Q1 is that there has been a lot more selling than buying. So yes, overall, over the last 12 months, institutions have been buying more shares, but what we can clearly see from here in the more recent quarter, institutions have been selling. Again, possible bearish scenario there, something just to consider in your own investment piece. Now, for those that did miss Broadcom earnings, they absolutely were very strong. In fact, they also increased their forward-looking guidance, which is always a very bullish signal, and the market responded. In fact, as we can see, after they reported, they were up over 10%. And we can see here they beat on both the earnings per share as well as a revenue, which is always a very strong sign. And they do discuss within this that the AI applications of the chip makers continue to be growing from all of their consumers. And this is why we can see that this isn't something that is slowing down. This isn't quite a bubble, as consumers, clients are continuing to buy their chips. And as we can see, very bullish given the fact that they did increase their guidance moving forward. Now, this will help with Nvidia for those that do believe this is a bubble and it could be slowing down, but we're going to show throughout the episode that this could just be potentially the beginning. When we take a look at the artificial intelligence market size, not only can we see it increasing massively over the next 10 years, but when we look as far out as 2030, the thing that will really draw your attention is the machine learning 503.4, so the largest driver of this growth in this industry. And this is one area that right now Nvidia are leading the number one. So if they continue to lead, then this is another bullish area for Nvidia to grow their top line as well as their earnings per share, which continues to increase extraordinary over the last few quarters. Now, this isn't just one article that we've seen. There are a few of these that do talk about this continued growth. We have another market research paper that talks about just over the next 6 years that they anticipate a compounded annual growth of 35.7% to the global artificial intelligence market, which again, Nvidia is leading the drive towards this over the next few years, especially in terms of the numbers that we can see. Research paper from PwC, they talk about this industry increasing, and in fact they put a massive number towards it. They talk about 15.7 trillion, and they do call this a game changer. They talk about how the GDP of countries will continue to grow massively, even up to around 20% from the benefits that can be seen from the drive from AI. And we also have a report from Bloomberg that believe a 1.3 trillion market just on generative AI. And as we can see, that is a compounded annual growth rate of 42% over the next 10 years. So lots of growth anticipated. This is an area that is going to be slowing down. That is just one thing that we do want to reiterate. A lot of people believe that maybe this is a fad, maybe this is a bubble, but the numbers right now don't support that thesis. So lots of bullish signals, but as always, we do also like to look at the bearish signals as well to have a well-rounded approach. Now, finally, before we take a look in depth at their report and investor presentation as well as some of their numbers, we just want to take a look at ARK's essential estimation for Tesla over the next few years, and they really have a massive expected growth rate, $2,600. This isn't something that we typically use in our analysis, but the only reason we wanted to bring this up, as well as other bullish signals, is because in the future, ARK are estimating that AI is going to play a massive role in the increase of the share prices of companies, and ultimately the reason why these share prices are going to increase is the underlying metrics, like their top line, like essentially their gross margin. As we can see here, they're estimating just for Tesla that their top line on a bearish scenario is going to increase from 5.8 million cars sold to 1.8, and that doesn't even include the robo-taxis and the robotics, which is going to help again drive the top line of Nvidia, as we are about to run through and discuss. So now let's take a look at their numbers on a top line, and as always, we want to see for a standard company 3 to 7% growth year on year baseline. For Nvidia, we see 4.7 billion in January 2015, and in fact January 2024 61 billion. So we can see massive growth over the last 10 years, and we will look at their margins as well, as we really want to establish here that this is a company that has propelled their top line as well as their margins, and as we're about to see, their net income bottom line as well. So massive growth of the company, although you could argue that the massive growth that we have seen has just been from the more recent year, but with all of the numbers and the backlog that they do have, this is expected to continue over the next few years at a bare minimum. And we can see the same growth noted on the bottom line net income, 631 million to just under 30 billion. And again, as we can see on a graphical basis, the majority of that growth just in January 23 to January 24. But as we're about to see in their latest quarterly report, it doesn't look like this growth is going to stop at all, with a large region of this being that growth in the data centers. Now, we also like to, as always, do a quick health check, total cash versus total debt. What we can see, 4.6 billion in cash and short-term investments in January 2015. The latest quarterly report, just over 31 billion. So they're also holding on to a lot more cash over the last 10 years. Always a good sign to see, but as always in isolation, this number doesn't really mean anything. which is why numerically and directionally we do always compare it to the total debt, which we can see even though it has increased from 1.4 billion to just over 11 billion, their cash is much larger, so therefore showing us it wouldn't even take them one day to pay off all of that debt net of cash on hand. And we can just see here graphically that the total debt has been increasing over the longer term. Now, what I also quite like to do is very interesting to see not just their past performance, but also their forward expectations on the EPS. In fact, over the last 4 quarters, Nvidia have beaten the analyst targets. That is a 100% track record over the year. 4 out of 4, always a good sign. And forward looking, just look at that earnings per share growth over the next quarter. Triple digit, 135% year on year. And even the next 3 after that, strong double-digit increases to the earnings per share. So again, this growth isn't expected to slow down anytime soon. And if you do have confidence over the last 4 quarters, then hopefully they should even be beating this over the next 4 as well. On top of that, in terms of January 2026, so if you want to look out even further, if they do hit that earnings per share estimate, the forward P will drop down to below 38. So again, whilst you could look at this now and say that the forward P is very expensive, if you do believe that over the next few years that earnings per share is going to increase at a very strong rate, then in reality that forward P could drop quite substantially. Now, a few points that we want to look at, especially in terms of their gradings. The first one is the valuation grade. Now, they do get an F, and we'll run through why that is. Main thing that we can see here is that on all of the valuations, they are trading at a much larger premium than the sector median. Now, the reason for this, as we will see, the sector median as a whole doesn't have the strength in the numbers that we see for Nvidia, but let's get to that in just a second. Non-GAAP then forward-looking 50.3, others in the sector just under 24. And as we mentioned, even if you want to look on a price to free cash flow or a price to book, they are trading at a much larger premium than others in the sector. We then take a look at their growth rate, and now you'll understand why exactly they're trading at that premium. Year-on-year growth over 200%, while sector median low single digit, forward-looking strong double digit over 80%, sector median mid-single digit growth at 6.67%. In terms of the earnings per share, over the next 5 years, they're anticipating 32% annual increases to the EPS, others in the sector 13.91. So you can start to wonder and start to analyze now whether or not you believe that it is justified, their valuation. That is a separate question, but what we can see right now in terms of the sector median, they are trading much, much better in terms of growth. And what we can see right now as well, on the profitability, the same story to be told, an A+. So gross profit margin 75%, sector median 49%, so a lot better. And that is a thing of beauty to see. A net income, a bottom line margin 53%, with the sector as a whole low single digit. So absolutely incredible. They're smashing it with not just their top line growth as well as their bottom line net income, but also these margins, which we will see graphically as well for the historical numbers. It is a thing of beauty to see. Now, cash from operations 40.5 billion, and as we can see, the sector as a whole in terms of a median aspect just under 100 million. So to wrap up this part of our analysis, one strong buy rating from Wall Street, a double hold from the other 2 analysts, an F for valuation, A+ on growth, A+ on profitability as well. So lots to like about this company, a few bearish indicators that we have discussed as well, but overall it is looking positive just from a purely high quality company aspect. Now, for those that always like to see how they've performed against others in the industry, what we can see here over the last 12 months, Nvidia up 207%, even Avgo that has had a very strong run just over the last week doesn't compare at all. When we expand this over the last 5 years, again, very similar story to be told. And again, over the last 10 years, absolutely no question, Nvidia has been the best performing stock by a massive mile. Now, what we also like to do on this channel recently is compare it to the S&P 500, because ultimately, if you're investing in a company that hasn't historically beaten the S&P and you don't believe it will in the future, what's the point? You may as well just invest in a low-cost ETF like VO or SPY. So S&P 500 over the last 12 months is up 24%. Nvidia continuing its incredible run, up 207%. Over the last 5 years, again, S&P doesn't come anywhere close, and over the last 10 years, we can see Nvidia smashing it up nearly 29,000%. So now let's get into essentially the investor presentation. A lot of useful information you don't want to miss in this today. Before we do get in though, we just want to point out we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on that pinned comment below. You can sign up and read straight away. For example, if you want to find undervalued stocks, we run through all the resources, all the screeners that we use on the channel, so you can do it yourself. Or if you want to see 12 high quality undervalued dividend stocks, again, you can just click on that link and take a look at all 12, completely free and instant access as well. Now, the first part of the slide that we do want to discuss is just the improvement in terms of looking at their chips. If you did see their latest conference, in fact, they are releasing Rubin in 2025, I believe, which is going to be even stronger than Blackwell, which is already very strong, and they have a massive amount of demand. So this is one reason why we believe this isn't a company that is slowing down anytime soon. We can already see the growth going at a very rapid rate. Now, when we take a look at what is to come with this company, well, they talk about how the adoption in the world of accelerated computing is going to be in each sector. We have cloud service, we have the enterprise, we have the autonomous vehicles like the robo-taxis, as well as the robotics that we touched upon with Tesla, as well as industrial digitalization. And they talk about how a new computing era has begun. Now, what I really like about this is that Nvidia have then gone along and said how exactly their products are going to be helping with each part of this acceleration, and they talk about their different products. So again, they are looking at this from a very holistic approach, and they can see how they are going to bring value to this across the board. Now, what is also very strong to see, the amount of developers that we can see have increased just over the last few years, as well as the AI startups, the GPU accelerated applications, as well as the downloads, just showing how much of a strong ecosystem that they have and the continued growth just over the last 3 years. So over the next 3 years, we do anticipate this will grow at even more of a rapid rate. Now, when we take a look at where all this essentially is going to be used in terms of the different avenues, is it just going to be used in computing? Well, no, not at all. As we can see, we have customer service integration with AI, we have drug discovery, agricultural, food, climate, and they talk about exactly how each one of these are going to help the productivity and creativity across every single one of these industries. Looking at generative AI and how they discuss this to be the most important computing platform of their generation. And one thing that I do quite like to take out from this slide is that they say 1,600 plus generative AI companies are building on Nvidia. So this really is the market leader if you are considering adding a company in this industry to your portfolio. As we're about to highlight, there is no other company that comes anywhere close. Now, in terms of looking at how historically it has been, well, we have the classical computing here, 960 CPU only servers. Now they're talking about accelerated computing with only 2 GPU servers, and the benefit with this that they talk about, 25 times lower cost, as well as 84 times better energy efficiency. So again, they're not just improving in terms of the applications, in terms of the efficiencies, but they're also talking about lowering costs as well as helping with that energy efficiency. Now, one thing that is very important, one of the reasons that you may want to buy one of their products as a client is looking at getting essentially money out of this, and that is exactly what they are talking about. They are saying here that $1 upfront investment in Nvidia's computing and networking can translate into $5 in revenue over 4 years, which is very strong. Just in terms of $1 billion investment would ultimately give you a $5 billion return over a 4-year period. And again, no other competitors have come close to establishing something like this in terms of return over this period. Now, in terms of the numbers, as always, we love to look at numbers. We want to see top line revenue growth. We want to see margins increase as well. FY20, 11 billion of revenue, 61 billion in FY24, just 5 years later. And with just 1 quarter gone, 26 billion in terms of the year-to-date numbers. Very strong. We're expecting the FY24 number to be blown out of the water. And on top of that, as we always say, we love to see revenue growth. But look what we have here. Operating margin, 34% in FY20, 69% year-to-date in FY25, with the previous full year, 61%. So this is going to make them a lot more profitable, with hopefully that bottom line net income, which is already very high, going to increase at a rapid rate. And in terms of where the majority of this growth has come from, well, we can see here, 36% in terms of the data center in FY22. From the same quarter in FY25, 87%, and that is very interesting to note, as that is a massive increase just over the last few years. It'll be interesting to see how much bigger this does get over the next few years. Now, what we also like to see, not just the operating margin, but in terms of the gross margin increase, 63% to 79% in FY25. So we are seeing a lot of efficiencies across the business, not just operating efficiency, but as we can see, the gross margin as well getting even higher. Now, when we take a look at their cash flows, as we will come to look at an in-depth analysis, cash flow is very important for a business. One of the major things that I look for in a company, consistent large increases to their free cash flows. What we're seeing, 4.3 billion in FY20, 27 billion in FY24, and again, just one quarter at 15 billion. If we were to extrapolate this over the 4 quarters, that would be looking around a 60 billion total free cash flow. Again, more than double the previous year. So lots to love in terms of where this company has been historically, but also over the next few years. Just in the short term, lots to get excited about. And on top of that, share repurchase, very nice to know. They have utilized cash, around 9.5 billion of repurchases in the full year 24, so last year, and they still have just under 15 billion remaining with authorization at the end of Q1. So again, returning excess cash to those shareholder pockets. In terms of dividends, well, interesting to note, they paid out around 400 million in just the last full year. Whilst here they say the plan is to maintain, as we're about to run through today, they've increased the dividend by triple digits, around 150%, which is very strong, very nice to note. But as shareholders, with this, you aren't looking at that yield. You want to see that growth in the share price, which they have more than returned for the investors. Now, what is quite interesting to note, in the different segments where they have data center, gaming, professional visualization, what they note here, every single avenue stream, bar the professional visualization, their 5-year CAGR has been double digits. But again, the one that everyone will talk about will be that data center, 5-year compounded annual growth rate, 75%. Now, when we look at the growth, as we mentioned, the majority of this is coming in the data center, FY20 at 3 billion, 47 billion FY24, and again, if we extrapolate this, we are talking about nearly 90 billion, so nearly double the previous year. So absolutely phenomenal, and I do believe that this, if continues to grow at this rate, then Nvidia over the longer term will be looking like a much better buy when you do consider all of these factors. Now, in terms of the final slide that we just want to talk about, whilst we looked at where essentially these numbers are coming from, what they've also talked about is the opportunity into the future, and we've discussed how the growth of AI is going to be expanding, and they talk about specifically where they see a lot of their growth coming from. Data centers obviously taking a large part at 300 billion, but into the future they also talk about autonomous machines, 300 billion, and who knows whether or not they will do something with Tesla and their robotics that they have started to implement. But again, lots of growth in the future, not specifically targeted at the data center, which has been taking up a large number of plaudits just in the shorter term. So now let's take a look at the numbers. Now, we just want to very briefly touch upon the dividend safety score. Now, an 89, very safe score, effectively meaning that the dividend cut looks to be highly unlikely. Market cap now well over 3 trillion, and dividend growth, as we'll touch upon, 150% increase in May 2024. So in terms of dividend safety, I mean, it was just reaffirmed last week, not much to talk about. Dividend cut, highly unlikely. And for those that are interested in the last recession, what happened to this company? Well, negative 35% recession sales, which was below the average of the S&P, which sat at around negative 12, and they also trailed the S&P, negative 78, as we can see here, S&P negative 55. Now, in terms of dividend growth, love to see this triple-digit growth just last month, although over the last 5 years, only 1%, over the last 10 years, 8%. Reason for this, as we can see, prior to the increase this year, we can see 1, 2, 3, 4, 5 years where it was effectively maintained. In terms of increases, well, again, this year will be the first year due to that 150% increase, but they have been paying a dividend for the last 11 without a reduction. Now, typically on this channel, we do talk about dividend yield theory. It isn't essentially relevant, so we won't talk about it for Nvidia due to the low yield, but one thing that we will draw your attention to, the current forward P at 46.7 does sit higher than the 5-year average of 41.7, and when we take a look at the sector as a whole, 27.2, again, we did establish this earlier, Nvidia does sit much, much higher. But as always, you can argue between whether or not you see it as being justifiable and warranted. Now, just because we have the information, we just want to point out that on a free cash flow basis, they're essentially paying out 1% of their total free cash flow in dividends, which is very, very small. If they wanted to, they could do another 150% increase, but as always, this isn't a focus of this company. Now, in terms of the free cash flow per share, very important, we want increasing free cash flows over the longer term as well as consistent increases. Now, what we really see from here, yes, it has increased over the last 10 years, but the real growth has just come in the more recent period, and in fact, into 2025, they're expecting more than 100% growth. So again, they also believe, based on the numbers they are producing, that AI is just starting and the growth is here to be maintained for the longer term. In terms of sales growth, well, this is just a percentage format, very strong double-digit increases for the last 10 years for the majority. 2024, 126% on a trailing 12-month basis, 208%, absolutely phenomenal. Now, if you want to see total sales, just another format to what we saw earlier, but we'll draw your attention to the shares outstanding, returning excess cash to investor pockets. Now, what we note, they would have diluted your position over the last 10 years if you're a long-term shareholder, but you would not care one bit just looking at that share price return. And what is nice to note, just over the last few years, they have started to do share buybacks, and hopefully if they continue to do that alongside the share price increase as well as the dividends, you will get more excess cash returned to you as an investor. ROIC, as always, 10% or more to give us faith management are able to effectively allocate their capital, 12% or more for semiconductor-specific companies, and what we do note here, pretty much above that every single year, 61% in 2024, 78% on a trailing 12-month basis, absolutely phenomenal, incredibly attractive for shareholders or those who are looking to be potential shareholders. Margins, well, we've already discussed this. Operational efficiency, as it has increased over the longer term, and in fact on a trailing 12-month basis looks to continue to increase, and the free cash flow margin, well, very beautiful to see, well above 5%, and again, not just very strong in 2024, but also on a trailing 12-month basis, it does look to continue. Now, net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, and why we look at this typically for dividend-paying companies, because it shows us the dividend strength as well as the balance sheet strength, and what these are, the number of years it would take the company to pay off all of their debt net of cash on hand. It won't even take Nvidia one day to pay it all off. Absolutely phenomenal. A very strong balance sheet. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we want to get into the DCF model. Now we will use this to estimate the price of this company, and this essentially shows us the free cash flows year on year. Average growth rate 94%. That is phenomenal and is expected just over the next year to be over 100%. So for our low rate in today's episode, we are using 25%. With the discount rate, we are getting the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here an overvaluation signal. So if you believe over the next 10 years and beyond it will be around 25%, well, right now the share price implies a downside of 24%. For those who believe that is way too conservative and be way higher, at 30% we have gone for a medium target, intrinsically $140, and we can see here this would indicate upside of around 6%. For those that believe, again, that is way too low, AI is coming and it's going to be much, much higher. At 35% we can see the intrinsic value $192, and this does mean that implied upside on the current price at 46%. Now remember, these are very subjective, and you can grab a copy of this model in the pinned comments below to run your own numbers through, whether it's for Nvidia, others in your portfolio or on your watch list. But right now for today's episode, we will go with a medium rate of 30%, taking it through to the next slide. And what we can see then in today's episode, the intrinsic value, just the DCF model that we have run through, is just under $140. Now with the current price of Nvidia, even after the increase of 9% just last week, $132, we do start off with a margin of safety of 10%. Now remember, we only execute on 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, well, it is a buy at $126, so it isn't quite there yet. Now, you could argue, phenomenal company, that in fact you would be willing to pay less of a margin of safety or even at a premium. Right now, though, it is trading based on the numbers we have run at a 5% MOS level. Do bear in mind, though, this is based on a growth rate forward-looking of 30%. Now, as always, let me know your thoughts. Maybe that is sufficient for you to add. Maybe you want more. As we said, at 10% a buy up to 126, at 15% if you're interested at 119, and for those at around 20%, as you can see here, $112. So a 5% margin of safety based on the value today. In terms of Wall Street and their expectation, they have a price target of $130. So we can see they do believe currently there is downside of 2% over the next 12 months. So what we could argue here is that they see reasonable valuation at the current trading price. Now, it will be interesting to see their next quarter results if they continue to show not just an increase in their top line revenue, but also in the earnings per share, as well as essentially their margins, both gross margin as well as their operating margin. As always, though, do let us know your thoughts in the comments below. Is this one you're looking to add? Maybe it's one you hold, maybe it's one on your watch list, or maybe for whatever reason you just don't want to add because you do see this as a bubble. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.